Hi everyone. Today we're going to look at Chapter 8. Chapter 8 is actually broken down into 3 different sections. It covers a lot of information. The first part is going to look at internal controls, which are really critical for a company and their success. The next part we're going to look at would be petty cash, learning what is petty cash and how to do the journal entries for it and how to do the accounting for it. And then lastly, we're going to be looking at bank reconciliations. Bank reconciliations are the same as you would do for your personal account, although I know many people do not do bank reconciliations every month, but we're going to teach you how to do that, so if you don't worry. We're going to start out looking at internal controls. And when we think about internal controls, it's really important to think about why would we have internal controls? What are we trying to do? And there's several parts that we're looking at. But we want to protect our company. That's the goal. So we first have to establish what we'll call a protective armor to guard against the risks that our company is facing. To do that, you have to understand what risks you have, and you have to understand your company inside out to know how to fight those risks. Let's put it into context in a different way, maybe using superheroes. So if Iron Man is going to fight Doctor Strange, he needs something to stand up to his powerful magic. So if you don't find whatever's going to stand up to powerful magic, Iron Man's never going to defeat Doctor Strange. On the other hand, if you're fighting against the Hulk, the armor that we need is to withstand the Green Rage monster's strength. So if you can't withstand that strength, you're going to lose to the Hulk. It's the same thing with our companies. We have to understand what their power is or what their risks are so that we can figure out how do we face it as a company to allow us to put policies and procedures in place to fight those risks, or at least to mitigate them. When we're looking at internal controls, there are 4 basic policies and procedures we're going to be looking at. The first is protect assets. When we say protect them, it's not just from theft. We want to protect them from waste also. The other one is going to be ensure reliable accounting. To ensure reliable accounting, it means that things have to be accurate. We have to know that it's consistent. We want whoever's looking at our financials to know that they can rely on the information that we put out to them. Remember, it's not just inside the company that's looking at these financials. If it's a publicly traded company, it's required to be published. Various regulators and industry standards are being compared. People are looking at capital risk, credit risk, tracking investments. So there's a lot of information that's being looked at outside of our company. The next part is to uphold company policies. So our policies are going to tell the employees what they should do and how to do it. This helps when you're faced with some kind of an ethical dilemma to have some kind of guidance. But putting those policies in place gives clear instruction on what to do. And the last thing is going to be promoting efficient operations. We want our company to be efficient, and to do that, we have to make sure that we put things in place that allow it to flow smoothly. For publicly traded companies, there was an act passed called the Sarbanes-Oxley Act, also abbreviated as SOX. So SOX stresses the importance of public companies to maintain internal controls when it comes to financial reporting. It requires public companies to include details on internal controls. This is done in Section 404. The intent is to protect investors, and it requires annual proof that companies actually accurately reported their financials. They had to prove their procedures effectively prevented fraud, and they had to show that they'd addressed any uncertainties that they might have come across. Looking into how internal controls are created, COSO, or the Committee of Sponsoring Organizations, developed a model for internal controls, and it has 5 standards. The first one is the control environment. Now, this is where we want to make sure that we're exercising integrity and ethical values. We want to commit that we're operating competently, and we want to create an organizational structure in our company. The next is risk assessment. We want to create company-wide objectives. We want to perform risk identification and analysis. Third is control activities. This is going to make sure that we're following policies and procedures. We want to have a business plan for continuity and a backup if we need it. Next, we look at information and communication. That comes into play when we are trying to measure the quality of the information and the effectiveness of the communication that's coming in or going out. And lastly, monitoring. We want to make sure that we're performing ongoing monitors to make sure that our internal controls are being assessed. We want to conduct separate evaluations, and we want to make sure that we report any deficiencies we might come across so that if we come across them, we have a way to fight them. When we look at the principles of internal control, there are 7 listed here, and we're going to go through each of them individually. So the first one is to establish responsibilities. When we say that, we want to, every employee should know exactly what their job is. It should be clear how to do it, what to do, and who's assigned to do it. That way, if someone is at fault, it's a little bit easier to determine who's responsible. You can hold someone accountable. One example of this is a register in a store. So if people are sharing a register and cash comes up short, how do you know who to hold accountable? You don't, unless you only have one person operating that drawer. So one of the safety measures that companies should put in place is to have separate cash drawers for every person operating the register. I know that I've actually talked to students a lot in the last couple of years and found that many of them operate shared cash drawers, and that's not an effective internal control to prevent cash from going missing and be able to determine who's at fault. The second one is to maintain adequate records. So when we think about this, it's going to make sure that we're detailing the records, just like when we started our transactions, we had that documentation backup that created that transaction that we put into the journal entry. We want to keep those. So that's one way to maintain those records. Another one is we want to make sure that we're using the chart of accounts that we've established for our company. That way it's easy to see what accounts we're using, where things should go. We understand what kind of transactions go into each account, and it's less likely that transactions are entered into the wrong accounts. The next one is pre-printed forms. So when you think about like your sales invoices, you want to be able to account for each one of them. You don't want to miss a sale, but if you were missing a transaction or a printed form and a number was missing, then you would know that you were missing something. So the pre-printed forms and the pre-numbered sales slips kind of go hand in hand. But when you're thinking about that, you're just looking to see, how can you make sure that they have the control in place for those forms to be used. So if the sales slips are pre-numbered, then we can see that we've accounted for all of them. Same thing for like purchase orders. You're going to have numbers on your purchase orders. You're going to have numbers on receipts if you're taking in money, things like that. And then the last thing is computerized point of sale systems. And this is where we have those automated cash registers where you're not manually calculating everything. It's scanning things in to inventory. It's scanning out when you sell it at the register and things like that. So those kind of things have been put in place that help us a lot with internal controls. The next thing is to insure assets and bond key employees. So when we talk about insuring assets, when we have whether it's a building or if it's a vehicle, we're going to have insurance for it. But there's all the additional insurances that companies should buy to make sure that they're protecting their assets that they have. They would have different assets than we might have personally. When we talk about bonding key employees, bonding just provides that the company is going to get compensation in cases of property losses that are due to an act of an employee. So it protects us against an employee doing something wrong. Next, we're going to look at separate record keeping from custody of assets. So we want to make sure that we have separation of duties and that not everyone has access to everything. With our computerized accounting systems, that definitely makes it a lot easier now because you can have limits to who has access to certain parts of your system. So it would make sure that not everyone could go into like accounts receivable and log receipts in there, or not everyone could go into accounts payable and cut checks. You have limitations on who has access to different parts of the system. Part of the reason you want to keep this separate is to reduce the risk of theft. And sometimes, it can be harder if you have two people working together or colluding because they're agreeing to commit some kind of fraud, and one person might have access to one part, one person might have access to another. So sometimes that can be a little more challenging. But you want to put policies in place to make sure that the record keeping is separate from whoever has control of those assets. Next, we want to look at dividing responsibility for related transactions. So when we think about, if a check comes into a company, we're receiving a check, who has responsibility for what part? So typically you have one person opening the mail. You might have another person that actually processes the check to be entered into the system. And you might even have a third person that actually enters it into the system, and then someone else that takes it to the bank. It depends on how large your company is, but there should always be double checks in place to make sure that there is a separation of duties. So we don't want people doing, duplicate work. We want to split tasks out among people. So we might have someone that purchases inventory, and then we have someone else that does an approval of that request. Someone else separate would actually make the payment, but we want to make sure that we're keeping those processes separate. We might even have the last person be the one that records the transaction, but we want to make sure that there's a process and that we don't have the same person doing the entire accounting process. In smaller companies, it is more challenging, but as the owner, that's when it becomes your responsibility to do all of those double checks to make sure that you're protecting your own assets. Next, we're going to look at applying technological controls. So when we think about technological controls, we have to think about, we have all this technology that can help us now. So it's important to use that. So we think about like cash registers. They have the electronics records of every sale. So when you're selling something, it's reading the barcode and it's taking it out of inventory. It's recording it as a sale and it's doing it in real time. So that's one way to use technology as a help. Same thing with inventory. We can scan inventory when it comes in. So in the receiving side of it, we scan it, we enter how many comes in. When you're doing an inventory check, you have scanners that make the technology a lot easier. A time clock is a way to have technological controls that enforce people with their time or payroll. We have a lot of companies suffer abuse of payroll, and time clocks is one way to avoid that. You have someone clock in when they get there, clock out when they go on break, clock back in when they come back, and that way you have a detailed record of the hours they physically worked. It also is going to make sure that we have a way to audit the process. So when we're looking at, these technology, it allows reports to be ran to see if the process that was supposed to be done was completed in the way that we wanted it to be. It allows auditors to evaluate the efficiency and effectiveness of our internal controls. Some companies may have internal auditors. Some people may have just external auditors, but either way, we have to look at, what is important and how do we make those things happen. All right, so there are some things that we can look at when we're looking at internal controls. So when we look at, technology combined with fraud and internal control, we want to make sure that we're using technology to our benefit, but we have to be aware of some of the things. So one, technology can definitely help us. It can help us reduce processing errors because it's not as much manual entry, and we reduce some of that human error that can happen. It allows us to be more extensive in testing of records, so we can get a broader testing when information is more easily accessible. We have evidence of processing. So a lot of data processing steps are done by computer. So fewer hard copy items of documents are available to review, but we can scan those and we still have those as evidence. So we can see who recorded those entries, the date and time, the source of the entry. So we have a little more detail when it comes to those records. And then separation of duties. So again, we want to make sure that we have sometimes we have a smaller workforce, so we risk that separation of duties being lost. But with technology, it can help us have those different controls, so that can be very helpful. The last part we're going to look at is just the limitations. Again, we can't prevent everything. There's always that the human error possibility. It could be, completely unintentional, but there is that possibility. And then we also have the human fraud part. And we'll talk about the human fraud triple threat a little bit more. There's a handout that you can look at that has a little bit more information for that. All right, so this is the end of section 1, and we will continue on with part 2 in the next video. Thank you.